So all of these lease payments, if you discount using the interest rate implicit in the lease or the incremental borrowing rate, you get the lease liability. And to this lease liability, you will add lease payments made at or before the commencement of the lease, then you will add initial direct cost, then you will add estimated dismantling cost, etc., minus lease incentive to arrive at the right of use asset.
To keep yourself updated, subscribe to Indigo Learn and click the bell icon, and download our app OneFin to start learning on the go.
Now let us quickly summarize and recap whatever we have learned in lessee accounting. First, we started with recognition and measurement related aspects for lessee. So we understood that at initial recognition, lessee will recognize a right of use asset and a lease liability. What is a lease liability? The lease liability is nothing but present value of lease payments that are not yet paid at the commencement date, discounted at the interest rate implicit in the lease, and if that is not readily determinable, we will use incremental borrowing rate for the lessee. This is how you will compute the lease liability, and we took a number of problems to understand how to calculate the lease liability for a lessee. Then parallelly along with the lease liability, the lessee also recognizes a right of use asset. Now how do we compute the right of use asset? We take the lease liability. To that we add lease payments which are made at or before the commencement. So that is another component of right of use asset. Then we add initial direct cost which are incurred by the lessee. Then we also add present value of estimated dismantling and site restoration cost, which we also refer to as decommissioning costs. Now from all of these, we reduce the lease incentives, if at all any, received from the lessor to arrive at the right of use asset. Now when we calculate the lease liability, what all do we include in the lease payments? We include fixed lease payments and in substance fixed lease payments. These are the two things we include in the calculation of lease payments, and from that we reduce any lease incentives which is receivable, which will be received by the lessee. So lease payments include fixed lease payments plus in substance fixed lease payments less lease incentives. Then we also consider variable payments which are dependent on an index or a rate. So if it is dependent on an index or a rate, you consider them to be lease payments for the purpose of calculating lease liability. Whereas if it is not dependent on an index or a rate, if it is dependent on, let us say, performance or use of that asset, then you will not include that in the lease liability, and as and when you have to make that variable lease payment, you will expense it to the P&L, right? So this is another component of lease payments. Then apart from that, if at all there are any residual value guaranteed by the lessee, that will also be considered as lease payment. Then if there is a purchase option which the lessee is reasonably certain to exercise, that will also be considered as a part of the lease payment. And then if there are termination penalties and the lease term has been computed as if the lessee is reasonably certain to exercise the termination option, then even termination penalties will be considered as a part of the lease payments. So all of these lease payments, if you discount using the interest rate implicit in the lease or the incremental borrowing rate, you get the lease liability. And to this lease liability, you will add lease payments made at or before the commencement of the lease, then you will add initial direct cost, then you will add estimated dismantling cost, etc., minus lease incentive to arrive at the right of use asset. Then we understood subsequent measurement. When we talk about subsequent measurement, it can be the cost model or the revaluation model. When you apply the cost model, you take the initial cost or the recognition amount. From that, you reduce accumulated depreciation and accumulated impairment losses. And if at all there are any adjustment to lease liability because of remeasurement, then that will be adjusted to the right of use asset. So you will arrive at the carrying amount of right of use asset by considering these items. Apart from that, the entity can also choose to apply revaluation model by a class of asset as per Ind AS 16. Both the models are acceptable. It is based on the accounting policy elected by the entity. Then when it comes to depreciation, over what period should the right of use asset be depreciated? So the simplest way to remember this is, if there is no transfer of asset at the end of lease term, means the lessee will not get the asset at the end of the lease term. In that case, you will take lower of lease term and the useful life of that particular asset. But if there is a transfer of asset at the end of the lease term, that means to say the lessee will maybe buy that asset or there is an ownership transfer, in that case you will consider the useful life of that asset and depreciate the right of use asset accordingly. Okay, so if there is no transfer of ownership, then lower of lease term and useful life. If there is a transfer of ownership, then you will consider the useful life to depreciate the asset. Coming to subsequent measurement of lease liability, you will take the lease liability. To that you will add interest expense using the discounting rate, and then from that you will reduce the lease payments to arrive at the closing balance of lease liability. Now in cases where there is a lease modification or there is a lease liability remeasurement, in these cases you will adjust the lease liability accordingly. Now the depreciation and the interest expense will be recognized in the statement of P&L. Then we understood about remeasurement of lease liabilities because of change in lease payments, and here the lease payment change because of the existing terms and conditions of the lease. There is no change in the terms and condition. If at all there is a change in term and condition, we call it lease modification, right? So lease liability remeasurement happens when there is a change in the lease payments. Where what could be those cases? Maybe now the lessee is reasonably certain to exercise the extension option or termination option or the purchase option, or there is a change in the index or rate on which the variable payment is dependent on, or there is a change in the estimates of residual value guarantees, or some variable payments have now become in substance fixed payments. In all of these cases, we will remeasure the lease liability with a corresponding adjustment to the right of use asset. Now when we do this, we will have to see whether to take the original discount rate or the revised discount rate. Now we will take the revised discount rate if there is a change in the lease term, or if there is a reasonable certainty now that the purchase option will be exercised, or there is a variable payment that is dependent on a floating rate. In these three cases, we will use the revised discount rate, otherwise we will use the original discount rate itself. Then we understood the next aspect related to lease modification. This is one of the most important aspect of this standard. What is the meaning of lease modification? There is a change in the existing terms and condition. Now this change could be in terms of changing the scope, like increasing the term, decreasing the term, or adding one or more new right of use asset, or giving up one or more part of the right of use asset. That is a change in scope, or there could be a change in consideration as well. Now whenever there are lease modification, what the standard requires is you will have to remeasure the lease liability using the revised discount rate. Now here one specific treatment that you need to remember is, if at all there is a decrease in scope, you will first reduce the existing right of use asset and the lease liability proportionately. So whenever there is a decrease in scope, first you will proportionately reduce the right of use asset and lease liability, and whatever is the difference between reduction in asset and reduction in liability, that will be debited or credited to P&L. So this one specific aspect you need to remember, that if at all there is a reduction, first you will reduce the ROU asset and lease liability proportionately. So whenever you get an examination question, first target this: is there a reduction in scope? Reduction in scope meaning reduction in either term of the lease or giving up one or more right of use assets. So first thing is, if there is a reduction, reduce ROU asset and lease liability proportionately. We have seen examples on how to do that, and then after the reduction, whatever is the difference will be taken to the P&L. Okay, so that is the first part. If there is no reduction in scope, then the next thing that you need to check in lease modification is there an increase in scope by adding one or more right of use assets? The first one is reduction both in terms of lease term as well as the right of use assets. The second one is increase in scope by adding one or more underlying assets. Now whenever there is an increase in scope by adding one or more underlying asset, what you need to check is the increase in lease consideration commensurate with the standalone price of the increase in scope, right? So if the increase in lease consideration is commensurate with the standalone price, then you will treat them as a separate lease and you will account for them separately. But if the increase in lease consideration is not commensurate with the standalone price of the increase in scope, then in that case you will treat it as a lease modification and you will remeasure the ROU asset and the lease liability using the revised discount rate, and when you do the remeasurement, whatever is the adjustment needed, adjustment will be done both from lease liability and right of use asset. So what would you do there? First, you will remeasure the lease liability, and whatever is the change in the lease liability, that change will be reflected in right of use asset. Okay. Now here P&L will not come into picture. Apart from that, if there is a lease modification because of change in consideration, even there you will use the revised discount rate, you will remeasure the lease liability, and corresponding adjustment will be done in the right of use asset. Then we understood COVID related amendments, right? How to deal with COVID related amendments, and if at all there are rental concessions, the lessees have a choice to not to treat them as lease modification and account for them as negative variable lease payments. Those aspects we have understood. Now one thing that you need to remember, whenever there is a reduction in lease liability because of the rental concessions arising due to COVID, a corresponding check should also be done as to whether the right of use asset has been impaired. Because you are not using the asset for some period of time, then there could be a possibility, there could be indications that the right of use asset has been impaired. So that check has to be done independently by referring to Ind AS 36. Okay. So that was COVID related amendment. Then we understood exemptions available to lessees in case of short-term leases and low-value leased assets. So if there is any short-term lease meaning leases up to a period of 12 months. So if there is a lease up to a period of 12 months and which does not have a purchase option, then we consider them to be short-term leases. And if the lessee requires, they can have an accounting policy that they will not apply this lease accounting of ROU asset and lease liability. All this amela will not be done for short-term leases. So in that case, you will expense the lease payments on a straight line method, straight line basis, or any other systematic basis which gives a better presentation of consumption of benefits of that particular lease, right? So on that basis, you will expense the lease payments. Then we talked about exemptions in relation to low value assets. So if there is a lease of low value asset, then the lessee may choose to not apply lease accounting, and even in that case you can expense the lease payments on a straight line basis or any other systematic basis which gives a better presentation, right? So this was with relation to exemptions for leases. Then we understood about separation of lease component and non-lease component. So if there is a contract which has lease component as well as a non-lease component, based on the standalone prices, you will have to allocate the lease consideration. You will have to separate them and account for them accordingly. But again, here the lessee has an option to consider the non-lease component and the lease component as a part of a single lease component. Then we also talked about separating multiple lease components in a single contract. So if the contract has right to use more than one asset, then in that case we have to check whether each right of use asset is an independent right and it can be operated independently, benefits can be derived independently, and based on those conditions we will have to separate the right of use assets into different lease components, right? And if a contract has two lease components and one non-lease component, then you cannot combine all of three and say that there is a single lease component. In that case, you will have to necessarily separate the lease components and the non-lease components. Again, allocation of consideration based on relative standalone prices. Then we understood about when do we combine the contracts, right? You know, two or more contracts entered into with the same or related parties at or about the same time, maybe negotiated together, or consideration is dependent on one another, right? In those situations, you may have to combine two contracts and account them for as a single right of use asset. Then we also talked about portfolio application and presentation and disclosures requirements, right? Such a lengthy discussion on lessee accounting as far as leases are concerned.